Hello, my name is Muhammad Muizzuddin bin Muhammad Rosli.
Hi everyone, my name is Nonabila binti Zuraini. My matric number is AY98060.
My name is Nur Mulaim.
Hi, Assalamualaikum. My name is Nurhanisa binti Lanan, which is my matric number A19A0455.
Assalamualaikum. My name is Muhammad Nizam Azizi bin Najran. My matric number is A19A0360.
Hi and Assalamualaikum. My name is Wan Fatimah binti Wan Muhammad Wafi and my matric number is A19B0971.
To talk about introduction, this study is based on the analysis made to relate to the statement about the Legoland and Genting. This research will also look at each Legoland and Genting company's current financial situation for the next 3 years. It also to compare financial position for each company and identify the companies with the stable in financial position. Next, we have a Legoland background. The Legoland Malaysia Resort, Malaysia's first international theme park, opened on September 15 on 2012 in Iskandar Puteri, Johor. This is Asia's first Legoland. There were originally 8 theme attraction area. The Legoland Hotel cost 190 million ringgit with the water theme park, and Legoland Malaysia costing 720 million ringgit. When Legoland Malaysia first opened in 2012, it planned to draw 1.5 million visitors in its first year and raise more than 100 million ringgit. Okay. Next, we have a Genting background. The founder of Genting is Tan Sri Lim Guh Tong. Genting Highland is a hill station located on the peak of Mountain Ulu Kali in Malaysia at 1,800 meters elevation. Genting Berhad is now a major Malaysian multinational corporation. Finance Asia named the company number 1 in Malaysia for best publicly managed company on 2015. Best overall managed company for the decade was rated number 1 in Malaysia and number 2 in Asia by Asia Money.
Next, we will be talking about the financial analysis and financial ratio. So our team will be using the financial statements to present information to our assignment report about the firm's financial position. We have decided to review the financial analysis and financial ratios for 2 companies in the tourism industry, namely Legoland Malaysia Resort and Genting Malaysia Resort. This is because that both companies are under the same industry, which is the tourism sector, and they also have provided financial statements for the companies that recorded positive net profits for the years under review, which is in the year of 2017 to 2019.
Horizontal analysis is an approach used to analyze financial statements by comparing specific financial information for a certain accounting period with information from other periods. Analysis uses such an approach to analyze historical trends. Trends or changes are measured by comparing the current year's values against those of the base year. The goal is to determine any increase or decline in specified values that has taken place. A percentage or an absolute comparison may be used in horizontal analysis. Horizontal analysis can also be compared with vertical analysis, whereas vertical analysis particular financial statement.
I want to present my part. Horizontal analysis have 14 ratios. The first one is current ratio, second quick ratio, third net working capital, and then inventory turnover, fixed asset turnover, total asset turnover, debt ratio, debt to equity, time interest earned, gross profit margin, net profit margin, operating profit margin, return on asset, and the last one is return on equity. As we can see in the slide, this is the example calculation of current ratio for Genting Highland Malaysia Resort. We use this formula to calculate current ratio, current assets per current liabilities. So after we calculate, we got in 2017, Genting Malaysia Resort have ability to cover its current liabilities with its current assets was 2.1 2.17 times. In 2018, the ratio increased to 2,007 times, while in 2019, the ratio decreased to 1.71 times. It showed that 2018 was the more able to cover. The next example is Legoland Malaysia Resort. After we calculate, we got in 2017, Legoland Malaysia Resort have ability to cover its current liabilities with its current asset was 2.03 times. In 2018, the ratio increased to 2.06 times, while in 2019, the ratio increased to 1.93 times. It showed that 2018 was more able to cover its current liabilities with its current assets due to the highest ratio among 3 years. So I think that's all presentation from me. Thank you.
Next, we will talk about the vertical analysis. Our team had used vertical analysis to get an overall picture of whether the performance metrics are increasing or declining between these two companies, namely Genting Malaysia Resort and Legoland Malaysia Resort. This is because it is beneficial when doing regression analysis and trend ratio analysis, and this can also allow the entrepreneur and investors to examine the relative changes in a company's account over a period of time, according to Butler and Casey 2003. For the current ratio, both companies are still at a satisfactory level because with current ratio above 1.00 is considered safe and adequate and reflects a good level of liquidity. And yet, both companies still need to monitor and ensure the current ratio does not fall to a level lower than 1.00. In conclusion, although both companies' current ratio has slightly decreased in 2019, however, Legoland Malaysia Resort is better than Genting Highland Malaysia Resort because it has the largest compared to Genting Malaysia Resort due to the owners of the company have invested additional cash in the company and has the ability to cover its current liabilities. For the current ratio, both companies are still at a satisfactory level because with current ratio above 1.00 is considered safe and adequate and reflects a good level of liquidity. And yet, both companies still need to monitor and ensure the current ratio does not fall to a level lower than 1.00. In conclusion, although both companies' current ratio has slightly decreased in 2019, however, Legoland Malaysia Resort is better than Genting Highland Malaysia Resort because it has the largest compared to Genting Malaysia Resort due to the owners of the company have invested additional cash in the company and has the ability to cover its current liabilities to their creditors. For quick ratio, both companies are also still at a good and satisfactory level because their quick ratio is considered safe and adequate, which is above 1.00 and reflects a very good level of liquidity. They both have the ability to use their quick assets, which is cash and cash equivalents, marketable securities and debtors, alternatively the current assets less stock balance, to pay the current liabilities. Both companies also do not suffer in a difficulty borrowing on a short-term basis, and the organizations need to keep an eye on the quick ratio so that the quick ratio does not fall to a level lower than 1.00. In capital, Legoland Malaysia have a better performance compared to Genting Malaysia Resort, but still, Genting Malaysia Resort is still in a good shape and good value due to their net working capital that is substantially positive, which indicates that the short-term funds available from the current assets are far more than adequate to pay for the current liabilities as they come due for payment. Inventory turnover, both companies have succeeded in in avoiding stocking large numbers of slow-moving and high-cost products that will lower the inventory turnover ratio. Thus, the managers should be efficient in managing inventory to reduce keeping more stock than the customer needs to meet demands that will harm the company's inventory turnover rate and result in excessive inventory replenishment in the company. As for the fixed assets turnover, both companies have good and high sales efficiency in these 3 years. In addition, they have ensured that the fixed assets turnover does not fluctuate sharply. Legoland Malaysia Resort has higher ratio to reflect the effectiveness of the fixed assets to generate sales than Genting Malaysia Resort in the past 3 years. The table above, Genting Malaysia Resort has shown good effectiveness of total assets to generate sales. But the total asset turnover performance made by Legoland is still satisfactory even though the ratio decreased by 0.07 times from 0.17 times in 2012 to 0.10 times in 2014. But the analysts should be careful in using fixed asset turnover and total asset turnover ratio because the calculation for the ratio uses historical cost of the assets. To conclude, both companies were taking more risk on business activities as the debt ratio in the company increased for these 3 years. Overall, they have done a good job in terms of debt to equity or debt to asset ratio below than 1.0 that would be seen as relatively safe, whereas ratios of 2.0 or higher would be considered risky.
I want to continue vertical part. Debt to equity. In the year 270, Legoland got a lower ratio of 44.4%, reflect the higher amount of debt compared to Genting is 56.5%. Lastly, the total debt to equity in the year 218, Legoland company get decreased at 44.7%. while the Genting is increased at 76.7% by the stockholder equity. Furthermore, in the year 219, Legoland got lowest debt to equity ratio of 57.7% compared to Genting is 83.3%, which means if the risk of the stockholder is getting lower. Debt to equity ratio reflects the relationship between the stockholder equity and total liability of the company. Nextly is term interest earned. In year 2017, the term interest earned ratio to Legoland increased 59.75 times, reflect to Genting get decreased 11.47 times. Is still being able to pay back all the debt. Nextly, the time interest earned ratio in the year 218, Legoland company get higher is 38.50 times, while the Genting ratio was 0.026 times. The Genting interest earned in less than 1. It indicates the company might not able to repay the debt in due time. It will be a challenge to get a new loan, but Legoland is still able to apply the loan. In the year 219, the term interest earned ratio Legoland was higher, 94.32 times compared to Genting company. The time interest earned ratio was 5.92 times, still able to apply for a loan. Gross profit margin. In year 270, gross profit margin ratio to Legoland get higher, 17.2 23.74% compared to Genting Gate 23.52%. In year 2018, the gross profit margin ratio Legoland company get higher 71.37%, while the Genting ratio was 26.82%. In year 2019, the gross profit margin ratio Legoland was higher 72% compared to Genting company. The gross profit margin was 23.97%. The higher the gross profit margin, the better that means higher ratio the company made hard gross profit to sort up operating and other expenses to come up with a net income. Okay, for the last part to my part is operating profit margin. In year 270, operating margin ratio to Legoland get higher 29.60% compared to Genting get 23.09%. In year 2018, the operating profit margin ratio Legoland company get higher 29.52%, while the Genting operating profit margin ratio was 26.30%. In year 2019, the operating profit margin ratio Legoland was higher to 28.12% compared to Genting company. The operating profit margin was 24.76%. This higher operating margin indicates that the company earns enough money from its growing operation to pay for its variable costs as well as its fixed costs. That's all for my part.
As we can see in the slide, there are the findings of the three financial records of Genting Malaysia Resort and Legoland Malaysia Resort from 2017 until 2019. Firstly, we got net profit margin. Genting Malaysia Resort is lower compared to the Legoland Malaysia Resort. That means Legoland are good to indicate better income to the shareholder. This may be caused by Legoland that generate more revenue and strive to achieve the higher ratio. Moving on to the return on asset. Return on asset show how effectively a company can earn a return on its investment asset. Legoland Malaysia Resort also, which is higher compared to Genting Malaysia Resort. It shows that Legoland indicate higher return in front of investment. A higher ratio can get a positive feedback from investor because it shows that the company more effectively managing its asset to produce greater amounts of net income. Lastly is return on equity. Return on equity that measure the ability of a
recommendation. Our team recommends that all businesses keep track on their inventory using the inventory system so that they can raise their networking capital and prevent stock death and obsolescence. Next, our team recommend any potential investor who want to invest a company with a higher debt ratio to do so because the company's debt ratio has been increasing for the past 3 years, indicating that the companies have been taking more risk in its business activity. In order to meet their obligation, Legoland Malaysia Berhad can produce more cash by increasing revenues and account receivable. Lastly, the key to success is of a business which increase its net profit margin. Okay, for conclusion, according to the ratio review table, Legoland get more profit annually, which is in 2017 is equal 37.68%. 2018 is 37.12%, and 2019 equal to 37.44%, compared to Genting, which is in 2017 is 5.60%. 2018 is 0.44%, and 2019 is 7.33%. Genting profitability is declining each year, while Legoland is increasing.